Given that it's the first Sunday, we've had the pleasure of welcoming Mike Muller, head of Vitol Asia, back to the table after the summer. It's also sort of somewhat a summer review, Mike. I'd welcome your thoughts of how we've got to where we are in this first week in September. I say to you that we've now gone sort of up the mountain of the Ukraine war premium, and we're back to where we were the days before mid-February, $93 on Brent. Your sense of where the market's at now, can we say we have the war premium is now out of the price?
No, Sean, absolutely not. But I think we'll fill the half hour with the last week's events. If we go back to February, we're going to need to be here until tomorrow. Yes, we did see some major price corrections, but there are many other factors other than Ukraine in force here. If you just recap what happened last week, oil sold off about 11% on the week, starting with a rally on Monday actually, to then selling off $10 on Tuesday, Wednesday, and another $3 on Thursday before stabilizing on Friday at 93. With WTI in the 80s. That indeed, in the context of recent prices, doesn't feel like a war premium number, but of course it's still a plenty high price. But all the attention was on European gas, as it has been for the last months, because of the Russia-Ukraine backdrop, of course, and the correction there was about 38%. So we saw an all-time high, matching the spike we saw on the invasion itself, of around 340 something euros. And that's now sitting at 212. That's a massive correction, and I think it warrants a little bit further analysis into what happened. But back to oil, I mean, we had a confluence of other factors. I mean, we have continued weak data coming out of China, be it the industrial productivity in the factory space, or be it COVID-related lockdowns. It's certainly the only country in the world that still measures asymptomatic cases. Here in Singapore, the masks came off exactly a week ago. They're now optional in all spaces, but undergrounds and buses and airports and hospitals. But the strong dollar, the easing of the flare-up on Tuesday in Iraq, where we had a one-day spate of violence that caused concerns over supply because there was some misinformation floating around about invasion of oil production facilities, and the overall weaker macro picture, including this cost of living crisis we keep talking about, just biting and hitting home harder, and particularly in Europe, where the rhetoric in the media started talking about terrible winter, at the very same time that the specialist markets, people like us partaking in oil and gas supply and demand analysis, started concluding that maybe, just maybe, Europe can get by if the winter is mild and if some form of rationing were to happen on the gas. So all that gave us a slightly weaker picture, but I do think there's a lot of macro concern in there in terms of impact on the economy and recessionary fears.
Mike, I welcome your thoughts on that, because that's why I asked you if the Ukraine premium is gone or not gone, because the real question now, do I understand, is how tight is this market in which OPEC will be assessing? You mentioned a lot of bearish sentiment there, weak China, etc. So I'm wondering, from your perspective, is 93 on a downward dropping knife, or is it solid? Is it consolidating?
It's tough to say, Sean, but in terms of price action and market talk and money inflows and outflows that we observe, the market is generally in a risk-off mindset because of summer blues, because many companies have or seem to have or claim to have made their targets on the year and therefore are in a risk-off mood. So this adds to the potent cocktail of volatility, because a lot of players are on the sidelines, not least because of summer holiday with Labor Day in the US. That's going to be another thin day tomorrow, Monday. I would suspect that a lot of people who had length would have gotten rid of it on that price down move $10 ago, and the market is therefore not seeing the same sort of open interest, which again is an item that was lamented by Prince Abdulaziz bin Salman in his comments about a week ago, expressing concern that the market is not necessarily reflecting fundamentals, but reflecting lack of liquidity and money flows. But the one other thing I think that OPEC Plus will need to take into account tomorrow is Iran, where over the course of the last 10 days or so, there's been a complete flip-flop in public sentiment over will there be a deal, where I think 5-6 days ago, the answer was a resounding yes, it looks like it, to now it's in the long grass again and it's somewhere in the future. And that matters. It absolutely matters as we come into the peak demand period for Asia in particular. And in terms of APEC conference and then the October period where in Asia, large NOCs tend to sign up term contracts for the next calendar year. The whole mindset around will there or will there not be Iranian oil in the market is extremely important for OPEC Plus to take into account. I keep saying this every time I come on this forum, Sean, but the range of expectations by the experts out there on how these things will play out has never been broader. You can drive multiple buses through the high and the low end of the range of expectations.
Well, I mean, on the range of expectations, Mike, the Saudi oil minister did bring in one of them and punctuated the idea of a cut, which one would have really not put in that range, I think, this soon. That was an added piece of the puzzle. How do you digest that? A survey's indicating, a survey done over the weekend, 46% expecting a cut. Your thoughts, is it too soon? Does OPEC need to hold their fire to when it really could have impact?
I think what we need to bear in mind is that people do worry about spare capacity, and not just geopolitical disruptions, but also weather disruptions, and of course the entire sanctions picture. So I guess we'll come back to price caps in Russia in a while. But I think on the gas, the TTF, the market has had a very clear demonstration of what happens to price when there's a concern about capacity and effectively a rationing mindset. I mean, that explosive move in TTF up to 343 euros per megawatt hour is something obviously we haven't seen in oil, but we have to bear in mind that in oil, there's less oil in the US SPR. That's at something like 20, 30-year lows after the interventionist measures that were enacted by the Biden administration, with a whole bunch of other countries acting in concert with that. And at the same time, the period of price stabilization after COVID by OPEC Plus is also over, and there's a big question mark over the what next. So by expressing a willingness to take oil off the market in response to either oil coming into the market from Iran sanctions being dropped, or from lack of demand in China due to COVID repression measures, it just serves as a reminder that we're not going to see everybody producing flat out. And therefore, I think we do need to bear in mind that there needs to be a risk premium for the lack of spare capacity in oil markets.
Mike, I wanted to get your thoughts on this oil price cap that the G7 have, I would say they've signed on to, but not, and it's not anywhere near initiated yet. Obviously, there's all these mechanisms that have to be brought into place. But your immediate sense of, is it market relevant yet? When will it become so? Or is it a distortion for the market finding a fair price? What are your thoughts on this mechanism, Mike?
It's probably the most discussed topic in the last 24 hours on social media or specialist online media, and it's awfully hard to say, Sean. The industry has obviously been aware of this desire to put in place such a cap for the last month and a bit, and has largely dismissed the possibility of doing so in a way that actually works. I think we have to bear in mind that Russia's production is a much larger number than Iran's production. So you can't draw parallels about sanctions taking effect in Russia in the same way as Iran, because Russia has the capability to produce 11 million barrels a day of oil. That's 11% of global supply. And its exports at 7+ million barrels a day of crude oil and products combined are an even greater percentage of the global supply picture. It is impossible, let me repeat, it is impossible for the world to get by without all of that. Yes. And if you look at what's happening with Nord Stream 1 and Nord Stream 2, there have been moments, days, weeks where all the Russian supply has been shut off to certain countries for various technical and I would argue political reasons. So a way must be found to allow Russian oil to continue to flow into markets, because unlike the inventory build of gas in Europe, and people saying they might just get by with rationing, austerity measures, and hopefully a milder winter than last year, that does not apply to oil. It's impossible for the world to get by with not having 7% of 7.5 million barrels a day of exports. So what a price cap might seek to accomplish is that the Russian oil goes to a larger number of markets under a framework that is actually more fungible. In so doing, of course, the 1, 2, 3, 4 markets where most Russian crude oil is flowing now, or will flow once the sanctions take further effect later this year, will be spread out more widely. So therefore, the discounts we're currently seeing in place for Russian crude oil and product exports will possibly diminish at the same time that more participants are brought into the fold. But I haven't in my own mind yet figured out how the price cap will actually be enforced. There is talk, of course, of exerting pressure on those pieces of the supply chain where the G7 that are driving this have a certain degree of control, such as shipping and insurance. And I guess those are the levers that need to be further understood.
The Russian government responded by saying any country that adopted this would be not supplied with Russian oil. In the sense that threat there, obviously, and we're seeing what's happened with gas, and one would have to assume at some point the Russian government isn't going to wait for the Europeans to cut off the oil. They'll probably cut it off before that. I don't know. It would seem if they're going to use it as a weapon, why would they wait? And also the idea that OPEC could cut at any minute. When you have those two, as you said, 10% of the world's supply each, how can oil drop any further when we're one announcement away from a sizable geopolitical action that could really disrupt supply?
You've tried 3 times now, Sean, to get me to say that $93 Brent is cheap. You know,
well, I'm wondering how vulnerable is $93 oil? How defendable is it from the OPEC perspective?
The range of supply and demand estimates is all over the show, as I said earlier, and therefore there are people that think there's plenty of supply, and there are others who think that it's looking very tight. So, Sean, take your pick.
Let's just wrap up around China, Mike. You mentioned China in your earlier comments. I want to, because obviously you just got the fairly negative sense of where Europe's at. I want to get, Mike, your sense of where is China at from your perception? Obviously, the zero COVID policy is kind of the front and center of China's challenge at the moment economically, but it does seem increasingly that their challenges are multipolar beyond the zero COVID. With the Communist Party meeting coming up in a matter of weeks now, what do you see beyond that in terms of where some of these trends might go in China?
So much to say in so little time, Sean. The 16th of October indeed has come as a bit of a relief. So we now know when that Congress is taking place, and everyone expects some degree of opening up of the travel restrictions that have seen the world bereft of the Chinese tourist and the Chinese businessman, which is so important out here in Asia. I talked about the COVID-related lockdowns and the industrial productivity concerns, but the biggest underpinning, I think, of the narrative at Gastech in Milan is going to be the fact that China has imported, or is heading for an annual total for 2022 of importing 18-19% less LNG than it did in the prior year. Now, we mustn't forget that the 2021 actual was a big increase of similar proportions on 2020, but nonetheless, that has come as a surprise and is just symptomatic of what's happening across Asia, which is demand destruction and fuel switching. LNG has been at the equivalent of a notional $80-something per MMBTU, which to most Asian economies is unaffordable. So what do? They switch or they abstain. In the case of those that can switch, they're burning a lot more coal. And that's been a serious factor in the market, where this volatility in high price market has brought all the energy commodities together in a way that they haven't been connected in the past. But the abstention, the demand destruction mustn't be underestimated also. In some South Asian economies, they simply don't want to buy. And I don't think there has been a fixed price LNG trade out in Asia at more than $60 per MMBTU, when for a number of days it's been trading at 70, 80 something. So that's telling you that various countries are washing their hands of it, burning more coal or reducing industrial output. So it's not just Germany, France, etc., where high energy intense factories are idle, and people are lamenting the fact that industry is uncompetitive. It's happening across Asia also. Now for China, the hope and my constant input into this meeting, as I'm more of a China bull than most, is that things will get better and demand will improve. But right now the headlines are going the other way, with 10+ million people locked down in various parts of China. The epicenter of COVID seems to be Shenzhen, just the hinterland of Hong Kong, the great tech megalopolis, if you like. So that is weighing on sentiment for sure.
Just to wrap on that a little more, Mike, the sort of behind the COVID curtain, there is the big transformation of China from the industrial sort of construction industry of the last 30 years and now transitioning towards the higher value, the technology, etc. That change in the structure of the Chinese economy, one very energy intensive, the one they're trying to transition to is less energy intensive. And I'm wondering, from your perspective, in that change, where do you think we are? And coming out of this cycle that China's in, will we drift lower rather than higher in that sort of energy consumption, energy intensive economy?
Many forces here. I mean, as people know, the demographic of China, thanks to the one-child policy, is not a rampant growth in the population, but there is a rampant growth in the affluence in the economy and the growth of the middle classes and their consumption patterns. So I think you are going to see headlines dominated by the ever-present, ever-grander story, and the fact that it was the Chinese construction sector, which is energy intensive, of course, cement, etc., which weighed down on all the indices we're looking at. But that's the very sector the government is now looking to boost and bolster with their very formidable reserves. So I think they're taking steps to counter that, and I look forward to seeing evidence of greater outputs in indices like cement and asphalt and paving, road building, etc., where China still has some way to go in certain provinces that haven't yet seen the huge wave of investment, where literally in the last 2 decades, they've built a highway system equivalent of the interstates in the USA, crisscrossing various affluent provinces. So I think there's some running room left to go in China.